Howdy, Jacob here. Today we're looking at CME Group. They are in the capital markets industry with $74.1 billion market cap on $75.1 billion enterprise value. So pretty much flat in comparison to their market cap. A 4.7% dividend yield. Growth on revenue has been fairly consistent, 2.93 billion in 2013 up to 5.0 billion in 2022. Margins have expanded and are absolutely humongous. 81.1% gross margin up to 85%, and then 56% in 2013 to 60% 2022. Dividends have grown, earnings per share have grown, return on invested capital has grown. This is a lot of positive news here, a lot of positive financials. Their balance sheet has 2.7 billion cash on hand, with 3.4 billion long-term debt. Okay. Their free cash flow pays out 3.2 billion in dividends, and their 5-year average free cash flow is 2.6 billion. Their cash from operations are massive in comparison to their capital expenditures. That's good. They are paying a lot of dividends here, and looks like maybe on an average basis a little bit going towards acquisitions, but really not much. And then a little bit of repayment in debt last couple years, but probably 90% of their money is going towards paying a dividend. I mean, if the company's into it, and it looks like they've been very consistent in paying out an excessive amount of their free cash flow in dividends, I'm fine with that. But I do always like some buffer here, so I'm going to cut it by a quarter to where their payout ratio is more like 65 to 75%. Still very high, but they have a little bit of margin of error with their free cash flow, so they don't have to dig into their cash, which really is fine. I mean, their cash and equivalents on hand is pretty much equal to their long-term debt, so the balance sheet's not too concerning. It sucks when you never see a company buy back shares, because there's no way their stock price hasn't been stupidly cheap at least once in the last 10 years. It just doesn't seem likely to me, especially to management. I mean, management's always about buying back shares in the most cases. It usually doesn't do it at a fantastic time, but I feel like no share repurchases is pretty surprising to me. I would think that they'd use some of their excess cash flow to buy back shares that are stupendously cheap, which seems to be pretty common in the capital markets industry. I've noticed that with Lazard and T. Rowe Price and Janus Henderson. They allocate a lot of money towards share repurchases, which I'm just not seeing here, which could just be the way Quick FS is done, but I'm just not seeing it, and I don't know how they would, because they're paying out so much in dividend. But some of the assumptions here, I think that they could grow relatively in line with inflation. No excess premium on PE or price to free cash flow. Margins look pretty great and are going up, but I always try to be a little bit on the conservative end. So I'll probably do maybe a little bit lower than their historical average, and then a little bit issuance a share. To me, the stock price has to fall 62% before getting a 15% return given these assumptions. I mean, the dividend itself has a yield of 4.69%, so that's pretty grand. But to me, I just never like companies that pay out a crazy excess amount of their free cash flow in dividend, and it looks like they're paying out 85 to 100% of their dividend or their free cash flow into a dividend. And so to me, I mean, is it safe from a balance sheet perspective? Yeah, it's not bad. Safe from a payout perspective, not incredibly safe. But I just don't think you're going to get a lot of price appreciation at this price point. And so to me, I'm just waiting. So hope everyone enjoyed the video and has a great rest of their day. Thank you.